So, guys, it is the 8th of December. I am back in the saddle at my office. Been gone, but had to hit Atlanta for a few days, and I was in Dallas. Had opportunity to speak with some folks that really set some things up for the future. It's really awesome. Be able to kind of share what that might be in the near future. We'll see. But a lot of things cooking up in my world. And we're seeing some good things happen in the market. We're seeing some good things happen with people buying houses, starting to understand that now is still the time to buy. Don't wait for, we start seeing the market a little bit better, but it's going to pause and see if rates get better. I don't know how much better they're going to get. So we're going to get into that here in a minute, but we did have this jobs report today that slowed down the trajectory that we've had. We've had this improvement. You hear the news talking about what's happening in interest rate world, that we've come off of the worst levels that we've had, which is true. We don't have the worst rates that we've ever yet or anymore, right? So that's reversed a bit, but we may see some slowdown in that. I don't know if that's going to be the case. It could just taper and just flatten out at this point, and keeping this current trajectory for the next little while. But what we did see is the jobs report came out and showed 9,000 more jobs than what they anticipated. So they expected 199,000 jobs created in November, but they expected 190,000 jobs to be created, but it was 199. But when you start digging into it, into the data that I've been getting shared with me, that some of it comes back from the strikes. When people coming back to work that were striking, they're counting that in there. So in reality, it's not as strong as they thought it would, as it's claiming to be, right? So people going back to work, I don't know how they can count that as jobs being created. So that's had a negative impact on the bonds today, which influences interest rates to be not as good as they were yesterday or the day before. So we're off of those levels, but still not a huge difference. So let me kind of share with you what we're looking at on these charts so you get a good feel of what we're doing. So a couple things I wanted to be able to illustrate with the chart here is, let me see if I can zoom this down a bit. Okay, so this shows you we had that downward channel, which this is the same chart, but different chart. So I took the channel out of it so I can play with these other lines. So it was all going downward. It was probably, if I can just draw that real quick here. So we had the channel that we were working with, and really just a trend line. I'll kind of show where that was. This would be the bottom of it, right? So we're working in that channel. I'm not going to draw it precise, but close enough, right? So we're in this downward channel. We broke out of it. We broke above it because they were really getting real with the jobs reports. We started to see that all the cooking that they were doing in the background, they couldn't cook it as much anymore. They even tried to cook it right now with the strike ending in some places and then going back to work, and they're trying to make it seem like there's more jobs being created. And again, they're monkeying with it, which they always do, same way they do with inflation. So now we've got that where we peaked out of it. Now we're in this spot here, where we come off of that peak. Interest rates would be at their lowest point that they have been since, let me see here, that would have been August of this year. So the only time that we were better was prior to, in July. And so it was better before that, but it was still, everything was going down as far as this channel is concerned, meaning everything was going up as far as rates were concerned. So we've seen hopefully the worst of it. But, everybody keeps saying, well, then who knows? It could charge back when we get back into the fives. I don't know that that's going to happen, because if you look here, we still have this. Remember this yellow line I drew way back? This is when quantitative easing was announced in 2008, November of 2008, when the Fed came out and says we're going to do quantitative easing, which means we're going to take a bunch of public money from the U.S. Treasury and dump it into the markets, $8.9 trillion over the window of time that they did. So as a result of that, in fact, I'll even zoom this out so you guys can see that. We still have that as a massive ceiling above us, massive ceiling. So it goes all the way back here, 2008, when that was announced. Here's the start of January 2009, when the federal government started putting money in. So here's the announcement. So because of the announcement, investors across the globe started putting money in. Then the Federal Reserve started actually putting the money in. This represents $8.9 trillion right here that was being invested by the federal government to subsidize the rates. And this is where they announced, right back up in here, October 2021, they announced quantitative tightening. Was it 2021? I have to double check that one. I believe it's 2021. Yes, October 2021, they announced quantitative tightening, and you saw everything just fell off. That's when they stopped putting money in. When that money stops going in, there's less to lend. When there's less to lend, the cost goes up. Supply and demand. So the supply shrunk, the cost went up, the rate went up. So when they increased the supply of money through here, dumping 8.9 trillion in there, those rates went really, 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 really low. So the reason I bring this up again, when you look at where we are, we went down to these very, very low points, and I can't zoom back any farther, but we went to some points that were back before like 2000, actually higher than what we saw in like the 2006 and 2005 area. And we came off of that. We literally dipped down into it, came back off of it. That would be, I would imagine, a really, really hard floor for us. But look, we've got this resistance here. I believe this ceiling here is going to be a cap. I don't think we're going to break through that 150, that par 55 that's right here. Definitely have that 102 up here where they established the quantitative easing, the actual release of the capital from the Fed. That would be another hard ceiling, in my opinion. Again, we've never seen this before. We've not done any of this kind of stuff before. I've not experienced this before. I've not seen what happens when you do 13 years of quantitative easing and then come off of that. It's basically, we've gone through withdrawals, if you will. We came off of that drug. We went through the withdrawals. We saw what's going on as far as the market reacting to that. That's why this went so far down so fast. So we're showing you that massive drop off since 2021. That's like withdrawals off of a drug, right? Now we're easing into some normality. I think we might be trading somewhere in this range going forward, I hope, but that's going to keep our interest rates high sevens, low interest rate, low eights, something like that, maybe even mid sevens for the real estate investor. And I think we might be able to get back to some par rates where you're not paying points. Points are very, very, very common these days. The reason they're so common, because if they gave you a 0 point rate, the way that the market was set up, where that market bottomed out, I showed you the very bottom being the highest point in rates, we would have been probably closer to 10% with 0 points. That's why you couldn't get a 0 point rate. Nobody wanted to give you a 10% or a 9.8 or a 9.9 or whatever that might have been. So in actuality, we probably got really close to double-digit interest rates for real estate investors. It just never was realized because of the points. So if you want more greater detail on this, we'll get into it more. I try and keep these short. Call me. We can talk about this. You guys know how to get a hold of me. 602-291-3357. That's my cell phone. Just text me. I'll have recess up on a call. But I appreciate you guys. I'll get you more data on Tuesday on how the market reacts to what's going on with the jobs report. Take care.